Hey, it's Andreas, and I've been investing for over 10 years. With earnings season approaching, I think it's a good time to take a look at what the media is saying on some stocks. And of course, I have to take a look at the largest holding in my portfolio, PRCH Group. And we can see here an article from Simply Wall Street where they do a discounted cash flow analysis and a SWAT analysis on the stock. And we will take a look at some highlights, some assumptions that I disagree with in the SWOT as well, but just walk you through the financial modeling of Wall Street that they do on stocks like this. So, to summarize, key insight here, PRCH Group estimated fair value 334 cents here based on the free cash flow analysis. We'll take a look at the components of it. Current share price of $1.68 here, as they wrote the article. It's $1.45 now, but potentially 50% undervalued here in this article. And just talking a bit about analysts' price targets here. Alright, let's scroll down to the numbers straight away. So we're taking a look at revenue growth in this case and putting some estimations on how quickly PRCH Group will grow their revenue, looking at just input here from a single analyst in this case. But the assumption here is that 2026 estimately 27% revenue growth, 20% the next year, then 14, 11, 8, 6, 5. So you can see that the revenue growth in the calculation is slowing down. This tends to be done as companies mature. However, the company is still small, and I think that smaller companies has a lot easier to grow revenue quicker than larger ones. So I'm not sure that I agree with the growth rate estimates. We could take a look at the current growth rate. It's been a lot up, but it has slowed recently as the company has discontinued higher risk insurance plans. And it has slowed down a lot in the software segment as a result of the slow housing market. And this could potentially turn very quickly as well and give very uneven and seasonal numbers in this case. So this would be the levered free cash flow here in millions in this case. And then they would use the discount value of 11% to give these cash flows a present value. So you can see here 15 million in 2025 is worth about 13.6 millions today. And then as we walk further and further out, this discount effect really kicks in. So we can see, for example, 31 million in 2030 only worth 17 million today, and eventually you calculate everything into a terminal value in this case, and from this analysis they got the number of $3 something a share. Here they have done the calculations. But why would they use 11%? Well, when you do the math, it tends to be with regards to the volatility of the stock. And as you know, with PRCH Group, they've been up to 4, and then they've been down to almost $1, and then now back up to $1.50 approximately. So huge volatility, and then with that amount of risk, because in finance, volatility is a measure for risk, you have a high discount rate. So this basically means that you don't put as much value on the future cash flows because they are uncertain, and we use this discount to compensate for that, basically. If you were 100% sure, like for example for US Treasury bond, let's say that's the closest to the risk-free rate that we can get, if you calculate future earnings for that, then you would not use 11% in discount rate. You might use 0.00 something like that to discount it, and just maybe do some discount for inflation or something like this, but not 11% for certain. So that's how they did the discounted cash flow analysis in this case, and it's interesting to read, and I don't agree with the input here. I think that this will fluctuate quite a lot from where they estimate it. I think we're gonna see very uneven growth in this case, but impossible to predict. But that's how you try to predict a stock price, and that's why we see so big changes in earnings when something change and it makes the models completely different. And well, then institutions have to put a different price target on the shares. Moving on to the SWOT analysis here. No major strengths identified for PRCH in the analysis in this case. Shareholders have been diluted in the past years. Yes, there's been some dilution when they did a purchase. There was some dilution. For recent years, it has been around 100 million shares in this case, and not changed a lot. Opportunity here, the amount of cash. They have some loans that are coming to maturity in the future. They did not refinance it straight away. I think that was a smart decision, as interest rates are going down now. And indeed, the price to sales ratio is just insane given how much revenue has grown, but profitability has not kept up in this case, and not share price either. But not expected to become profitable over the next 3 years. This is where I severely disagree with the SWOT analysis in this case. From listening in on management calls, there seems to be a lot of focus on profitability. They commented on wanting to be EPS positive here for the full year on a non-GAAP basis, so basically not really cash flow positive, but almost. And I think that they're working hard towards profitability. Why do I say that? It's not just something brought out of thin air. I took a quick look at the reviews regarding the company on Glassdoor from employees, and not too happy about the salary, and not too happy about the benefits, and no 401k match, etc., etc. Not super great reviews if you're an employee, but if you're a capital owner and you're listening on that, that really gives you a signal that they're keeping down the costs. They're focusing on capital structure and trying to really maximize shareholder values. Why not? The CEO in this case owns about 20% of the company, so there's a lot of focus on profitability in this case. And I don't think that the analysts has done that research. They haven't gone in on Glassdoor, looked at companies' reviews from the employees and extrapolated that to what it means in terms of cash flow from operations, in terms of potential impact on profitability. I think that they just do some predictions here based on, well, you saw the numbers here earlier from the discounted cash flow analysis, looking at the free cash flow. I hope you enjoyed this video, me covering some news regarding the PRCH Group. There's not been a lot from investor relations, no official press releases of interest to cover, and just doing this in anticipation of the next quarterly earnings, which I of course will cover for you guys. That's been it for this video, and as always, I hope you guys make a ton of money, whatever investments you decide to make. Take care now. Bye bye.